initially, if you roll the clock back a decade, we didn't have it. Every financial crisis we've had, right, in the history of the world, and we've had 10,000 of them. There have been 10,000 currency collapses, from the Lydians to the Athenians to the Spartans to the Romans to the Venetians, to the Brits multiple times, to the Carthaginians. You could just go on, and the Persians, and go on and on and on and on. And the history is full of examples of an empire rises, someone mints a currency, the successors or the children of the conqueror debase the currency, the grandchildren debase it more, the great-grandchildren forget how they actually got the power, they spend everything, go wacky crazy.
On Thursday, Bitcoin experienced a significant 7.2% decline, marking its most substantial one-day drop since November 2022, when the prominent exchange FTX encountered a major setback. Subsequently, during Asian trading hours on Friday, it reached a 2-month low of $26,172, the lowest level since June 16. These declines coincided with a global trend of selling across markets, as Wall Street's key indices closed lower on Thursday, and Asian shares appeared headed for a third consecutive week of losses. These market movements were driven by concerns surrounding China's economy and the persistent expectation of higher U.S. interest rates, stemming from the nation's resilient economic performance. Ethereum, the second-largest cryptocurrency, remained relatively stable at $1,685.20, despite also experiencing a sharp drop on Thursday. Some analysts attributed the decline in cryptocurrencies to a Wall Street Journal report revealing that Elon Musk's SpaceX had sold its Bitcoin holdings after depreciating their value by $373 million. Musk wields considerable influence among crypto enthusiasts, and Bitcoin prices have previously reacted to his tweets. According to Ben Laidler, a global market strategist at eToro, the SpaceX news served as the immediate trigger for Bitcoin's sell-off, although the broader factor was the increasing risk-averse sentiment prevailing across all asset classes. In contrast, Michael Saylor believes that market downturns are a regular occurrence, and that Bitcoin remains the sole asset worth retaining.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
We're in the middle of chaos. There is no place to hide. Your choice is, you could buy gold, but gold is dead metal and it's just getting ground into the dirt, right? I can seize your gold. Gold is, the half-life of money in gold is 35 years. And you can't put gold on 8 billion iPhones. So the problem is there's no tech in gold, and it was a good idea in the 19th century, and it's centralized, governments can seize it, and the gold miners keep debasing it. They keep mining more gold. Right? In the best year, you get 2% more. In the worst year, someone seizes a bunch of gold, dump it on the market, you get more than 2%. So people are looking for a safe haven. What's it going to be? Property in Africa? Property in Venezuela? You can't have property in North Korea. Property in Argentina? A business? A business where? A business in Argentina where the currency collapses? What good are your cash flows if the currency that you generate the cash flows are collapses in value? So I think here's the big idea, really big idea. Everybody in the world has to decide where they're going to locate their family. They have to, physically, they have to decide where they're going to locate their themselves in cyberspace, their mind. Are you going to watch Facebook all day long? Are you going to read Twitter? Are you going to be on YouTube? You're going to go to Rumble? Are you going to look at Instagram? Right? Where is your mind? Right? And then the third question is, where is your business? Are you going to run a yoga studio in Miami? How about a yoga studio in New York? How about, are you going to run a farm in Zimbabwe, a ranch in Argentina? Are you going to buy a company that has business interest in China? How about owning a bunch of businesses in Ukraine or Russia? Right? So where is your P&L? Right? And the fourth big idea is, where is your balance sheet? Okay, you're a podcaster on YouTube. Okay, well, you better make sure that you comply with YouTube platform requirements. Otherwise, they turn off your podcast and they crimp your business. That's where you generate your revenue and you generate your cost. But now, where are you going to save your money? Are you going to save it in U.S. sovereign debt? Are you going to actually store it in gold? Are you going to buy land? Where? In California? In Ukraine? In Russia? Where? in Florida, right? Are you going to buy S&P index stocks? Are you going to buy Bitcoin? Are you going to buy art? So there were conventional answers to all these questions, Brian, and they kind of worked for, there was an answer to this question before 1914. There was an answer to this question between Bretton Woods and 1971. There was an answer to this question from 1971 till the year 2020. In 2020, it's like, oh, the answer, 60-40 bond portfolio, buy the S&P index and like a portfolio of diversified bonds and you're good. Okay, there was an answer. The answer kind of got confusing after 2020. The answer got confusing for a lot of businesses, for a lot of people. Highlight of the year? The highlight of the year is people were stunned from March of 2020 to March of 2021. And from March of 21 through the middle of 2022, they're all starting to get their bearings and they're like, well, I guess, what is Bitcoin, a digital commodity? Do I have to deal with that? Well, now Fidelity's talking about rolling out the 34 million retail accounts. You've got the government embracing crypto assets, saying we better figure it out. Congress, senators getting educated on it. The CFTC, the SEC getting educated on it. Big institutional investors starting to take Bitcoin positions. The media now you've got Bloomberg covering crypto. You've got CNBC covering crypto. You've got an entire world, media, analysts, politicians, financiers, and they're all starting to figure this out. But I still say we're early, right? This paradigm shift takes a decade. And maybe the first decade was the embers of a flame flickering from 2009 to 2020. And then from 2020, we started pouring gasoline on that flame, right? The gasoline in the US is we triple the inflation rate, monetary inflation. But forget about that. Maybe you're a blue blood living on the Upper East Side with a trust fund and you just don't see why you need it. The gasoline in Sri Lanka is everybody lost everything overnight. The gasoline in Lebanon is the bank freezes their doors and you lose all your money.
Bitcoin has been lingering in the vicinity of the $30,000 mark for the past few months, making a gradual recovery throughout this year. This rebound comes after a sharp decline in 2022, triggered by the collapse of several cryptocurrency firms that left investors with substantial losses. In June, crypto markets received a boost when BlackRock sought approval to launch a spot Bitcoin exchange-traded fund in the United States. This move was interpreted by some investors as a positive signal, suggesting that the U.S. Securities and Exchange Commission might greenlight spot Bitcoin ETF applications submitted by various asset managers, including Grayscale. Let's return to the video to explore further if Michael Saylor maintains his bullish stance on Bitcoin.
I realized the half-life of money, the half-life of energy or wealth stored in the currency was 36 to 48 months. So I looked at $500 million and I said $500 million stored in US dollars at a 15 to 20% monetary inflation rate, divide 20% into 70, right? The rule is 70 and you'll, okay, got 3.5 years and half of it's gone. So I think I got to that point, and the significance of that for me, Brian, was I realized at that point that holding 500 million in cash at a 15% monetary inflation rate means that you lose 75 million a year on your balance sheet. And the best I could hope for is 2,000 people working themselves to death, doing 100,000 things right every year, everywhere in the world. And if we didn't screw up anything, and if everybody worked themselves to the bone, we could make 75 million.
Right.
So I had this inflection point where I realized everything we're going to do for the rest of our lives is going to be negated by the inflation on our balance sheet. And that's the point of hope, despair, and indifference, where you're like, it just doesn't matter what we do for the next decade because we can't get ahead. Now, that's a slow death, right? I've used the phrase, right? The road to serfdom is working exponentially harder for a currency growing exponentially weaker. Just a road to serfdom. That's a slow death. But if you took yourself and you dropped yourself into Venezuela or Zimbabwe, and I just told you, or Argentina, it's the same idea, but instead of a slow death, it's just a fast death, right? You might as well just open up a vein and let the blood drain out, right? It's not like giving a pint of blood a week. It's like giving a pint of blood a day, or I just open up the vein and I just bleed out, right? I mean, that's what hyperinflation is. So I would say we were jarred out of our lethargy, or jarred out of our conventional thinking because of that crisis. And then we had this couple of advantages. One, we had a huge balance sheet. And so if you were running on 500 million in debt instead of 500 million in equity, right? When you're running on 500 million of equity at 15% monetary inflation, it costs you 75 million a year. But when you're running on 500 million in debt, you're actually getting 75 million a year. So you see,
Right.
If you're an indebted company, you wouldn't be as sensitized to that. So we happen to have a lot of cash. We had positive working capital. And then we had a company with a fairly tight board, 5 people. We knew each other, and a very smart, engaged executive team and engaged board. And I'm the controlling shareholder of the company.
The U.S. Securities and Exchange Commission is on the verge of permitting the first exchange-traded funds based on Ethereum futures, marking a significant victory for multiple firms that have long sought to introduce these products. According to insiders, the regulator is unlikely to block these ETFs, which would derive their value from futures contracts of the second-largest cryptocurrency. Nearly a dozen companies, including Volatility Shares, Bitwise, Roundhill, and ProShares, have filed applications to launch such ETFs. In a separate development, the bankruptcy filing of China's Evergrande has had a far-reaching impact on the crypto markets, causing substantial drops in major digital assets and raising concerns about the financial backing of Tether. Once a prominent property developer in China, Evergrande has become a symbol of the country's property crisis. On August 17th, Evergrande sought refuge from creditors by filing for Chapter 15 protection under the U.S. Bankruptcy Code, a move designed to aid non-U.S. companies during restructuring and keep creditors at bay. Meanwhile, the SEC has taken a step forward in its effort to appeal a trial court's ruling regarding Ripple's XRP token sale on digital asset exchanges. The court had previously ruled that XRP was not a security offering. Judge Annalisa Torres has granted the SEC's request to file a motion, allowing it to argue for permission to pursue an interlocutory appeal, challenging the lower court's decision before the case concludes. This development comes after the court's recent ruling, which was considered a partial victory for Ripple, stating that XRP sales only violated federal securities laws when sold to sophisticated investors. The SEC's move has significant implications for Ripple and the broader cryptocurrency industry. Please share your thoughts on these developments in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.